Welcome to the Everest Insights, where we decode the intersection of capital, policy, and innovation for Asia's discerning investors. My name is Jeff Lee, CEO of Everest Strategic Asset Management. Today, we're diving into the extraordinary journey of Ram Parameswaran, a true Silicon Valley insider and one of the most thoughtful tech investors of our time. Ram began his career as an engineer at Qualcomm, transitioned into equity research at Sanford Bernstein, and then sharpened his edge at elite hedge funds like Qualcomm Edge and Altamira. In 2020, he took a bold leap and launched Octahedron Capital, a high-conviction tech-focused fund now managing over $500 million across public and private market. What makes Ram's story especially compelling to our audience, many of whom are Chinese high-net-worth investors, is his unique ability to generate exceptional excess return by identifying the best company in the global innovation ecosystems. Based in Silicon Valley and deeply connected through his wife Annu Harris-Haran's growth fund Afra, Ram has access to the most promising startup and scale-up in AI, software, and semiconductors, sectors that are increasingly difficult for Chinese investors to access directly due to the geopolitical tension. We'll explore how Ram thinks about stock picking, portfolio construction, risk management, and the art of exiting positions. We'll also uncover how Octahedron creates powerful synergies between public and private investing, and how his partnership with ESAM opened new doors for Chinese investors seeking exposures to the future of global tech. Let's get started. You started at Qualcomm as an engineer, then moved to Sanford Bernstein as a sell-side analyst. What did those early roles teach you about product intuition and analytical rigor? Transitioning from analyst to portfolio manager is a leap, from recommending ideas to owning outcomes. What mindset shifts were most challenging in that move? At Falcon Edge, a Tiger Cup fund, you were immersed in high-conviction investing. What raw lessons on team dynamics or market realities stuck with you?
Absolutely.
So maybe you can share a little bit about that.
Yeah, absolutely, Jeff. Thank you for having me at this podcast. It's fun to see you and catch up with you again. Thank you for coming for LP Day. Looks like you had a good time there as well.
Absolutely. Yep. I love it. Yep.
So the journey has been very interesting. And if I take a 10,000 foot view on this, it's actually not very different, even though it looks like many stages in the journey. The concept is still very simple. I love technology. And I'm an engineer. I grew up in India, Southeast Asia, Africa. And in some ways, working and living in all these parts of the world really has impacted the way I think about technology. So that's number one. So very lucky to have that kind of background. So I grew up in rural Indonesia, Nigeria, Kenya, India, all before I was 21 years old. Then I came to America when I was 21 to get my master's in electrical engineering at Virginia Tech. And part of the reason I came to America was, at least back in the day, India had no opportunities. It was it was the dot-com bust. And at least back in the day, India and America were very coupled economies from an equity perspective. So NASDAQ goes down, everything blows up in India as well. That has completely changed in the last 3 or 4 years, but that used to be the case back in the day. So I came to America to basically study, join big tech, have a nice house in Silicon Valley, and retire, which is the dream, right? Unfortunately, what happened was...
What year was it at the time? Sorry.
This was 2001 when I first came.
Okay.
And Jeff, life was difficult, right? My first job in America was I washed dishes. I washed dishes in the college cafeteria for $6 an hour.
Wow.
My furniture was... What's that again?
Yeah, so that's your part-time, or is it initially when you come to United States, when you study in Virginia Tech, you also work in a different kind of part-time job?
Yeah, I come from a very middle-class background in India. So first of all, in India, there are capital controls. You can't take a lot of money out of India. So I understand the pain of capital controls acutely.
Yep.
Second, the rupee to a dollar, it's so expensive, right? And America's an expensive country, even in 2001, if your parents made money in rupees. And so many of us came very middle class to America. And so typically you go and you find a research professor to do some work with, or a teaching assistantship. But in 2001, because all of university funding had dried up, there were no jobs and there was no research financing. So you had to make ends meet. So my first job in America was actually washing dishes. And then I rolled burritos. And then I became a cashier for the first, let's say, 6 or 7 months of my life in America. And luckily, though, I was able to find a professor who, my wife and I have an endowed fellowship in his name right now. And he gave me my first chance to do research. And the trick is, once you become a research assistant, you become a university employee, so the tuition is free.
Yep.
And he pays you a small stipend. So life was good. I also met my wife there because I know you're going to bring up my wife's topic in this conversation. So I met her also in graduate school. She was also an engineer from India, and her first job was flipping burgers. So when you talk to her in a different podcast, it's a very similar story.
Wow.
Anyway, we met there in 2001, 2002. And then by 2003, things were getting better.
So that one, let me interrupt. So you did not go through the typical Indian kind of matching process for the marriage?
No, there was no matching. She was really beautiful, and I met her in grad school.
Interesting. I have
So
so many.
more dating
I have so
than
many Indian friends, and I remember at one point he told me he went back home from US, and then his mom kind of arranged him to meet with so many female for marriage. Yeah. So I thought that's a kind of
one of them, Jeff, I think once you get to know me really well, you will learn that I never listen to anybody. So I never listened to my parents forever. It was never going to happen. Long story short is in 2003, there's only one company really hiring electrical engineers, and that was Qualcomm out in San Diego. Because Qualcomm, by the way, legendary engineering firm, and we had moving from simple phones where we just had voice calls to the first versions of data on cell phones. Now, this is even pre-iPhone, by the way. So this is 2003, 2004. And so I was the first class of engineers hired out of some of these elite electrical engineering institutions. So I studied information theory, digital signal processing, systems engineering. And so we went to Qualcomm and we were building 3G first on a commercial basis on the chips in the lab. And my first 3 years, I mostly spent out in Europe, actually. So I worked in Helsinki, Turin, Madrid, Frankfurt, just all over Europe, commercializing 3G for Qualcomm for the first 3 years. And my wife, Annu, also did something very similar. It was the rocket ship engineering experience, Jeff. My team went from, I think, 30 or 40 people to almost 3,000 people in 3 years. So what I call insane explosive growth, even at Qualcomm back in the day. Because imagine first data on phones after the crash. So insane scale and growth, massive responsibility at a young age. I was only 25, already became a manager, was managing people, working with my senior bosses. But along the way, I started getting a little disillusioned because the work had gone from doing really fun, difficult engineering problems to doing a lot of coordination and managerial work. And I wasn't actually having a lot of fun. Meanwhile, what I really wanted to do is I had always learned about Silicon Valley. Remember, I was in San Diego, which is not Silicon Valley. And I wanted to find my way to Silicon Valley. But one of the ways to do it back in the day was to go to business school and then become a product manager. Now, the big company in that time, 2003, 4, 5, 6, was really Google. That was a company taking off. And they would not hire double E's back in the day. They would only hire computer science engineers. So you had to go to business school to go there to find a job. So I started talking to my wife about, listen, maybe we should go to business school and try to change careers completely. And so what happened then was my wife, who really is smarter than me, for our honeymoon, we went to New York City, and then we spent our entire honeymoon touring business schools, right from Boston and Harvard and MIT, down to Dartmouth, then to Columbia, then to Penn. And then we were really amazed that this entire universe existed outside of our little cocoon. First, remember, we went from India to Virginia Tech, which is a rural campus, and then to San Diego, which is paradise. And so we're like, wow, this entire thing exists outside of a small focus. And so we applied to business school, and we had a challenge because she got in, I also got in, but we couldn't afford to go to business school together because business school is very expensive. And we got to take on a lot of debt, right? We don't have a lot of savings at 26, 27. We have no savings. But we were very lucky. We had the courage to take the leap because even then, and one of the concepts I've always loved is how do you think about asymmetry? So if you're sitting at 27, you have two nice cars in San Diego and you're good job and you're doing well, I think a reasonable answer is to just continue that life, right? It's the American dream. I've always loved asymmetry. So the question was, if I fail, I can get my job back, I think. Maybe I won't be at the same level, maybe I get a lower level, but if I succeed, something big could happen. So I've always had this internal concept of asymmetry, which is I think has made me a good investor because it's very difficult for a middle class person like me or my wife to do what we did. But I think one of the lucky, and I think it's luck, not skill. I think we've always had a feeling about asymmetry. What could go wrong and then what could go right? So always try. If it's too much risk, don't do it. So anyway, so my wife went to business school at Wharton, which is when I became an expat. In fact, those 2 years she was in business school, I took an expat role for Qualcomm and I lived in Latin America. That was the other big continent. So by the age I was 27, I'd worked in Europe, worked in Latin America, and lived all over Asia and Africa. So again, and I also lived in America. So the only country left for me was China at some point, which I'll come to later.
Yeah.
Anyway, so she went to business school. I went to business school later at the University of Chicago. And initially, when I went in, my plan was to go and become a product manager. Go back to Google, life is good. This is where I got very lucky. I ended up going to a business school, which is really the ground zero of finance and ground zero of economic theory and economic thinking. And I don't know if you know this for your Chinese audiences, but the University of Chicago is legendary for the concept of free markets capitalism.
Yep,
And
absolutely.
philosophically, the belief in freedom of individuals. So I go there, and again, instead of just struggling to find the banking job or the consulting job, which I still tried, I didn't get any job, by the way. I'll tell you that story too. I said, I'm going to study. I'm going to learn this entire new thing. So the other thing I think about that works for me is I actually love learning. I'm a bit of a nerd, both a history nerd, business nerd. I've always loved reading stories about people. And even though I'm an engineer in real life and I code, I program, I build, in my hobbies, my life is ready to learn. And so I went to Chicago, and that's when I discovered finance for the first time. And so for my internship, I said, I'm going to go apply to all the big mutual funds. So I went and I applied to Fidelity and T. Rowe Price, et cetera, et cetera, et cetera. And you know what? I pitched Apple long and BlackBerry short.
Okay.
And
So you
Jeff,
do have a pair trading concept at that time.
there was no concept, it was only instinct. I had no idea. Remember, I had no idea what investing was. Jeff, till 31, till 29, I'd never bought a stock in my life. Because middle class Indian people, they only save and put money in a checking
In the
account.
bank. Mhm.
Understand, my parents are very middle class. So there is no concept of investing and making money. So even in Qualcomm, again, remember, you don't make a lot of money as engineers. You make $80,000, $90,000, and after taxes and everything, you have not much money left. So what do? You use your options as your rolling cash account. You buy them at a 15% discount, sell it immediately, capture 15% plus whatever appreciation. That's what you do all the time. So at 29, but again, I love learning. So I said, this is so interesting. I think I'm one of the best. I'm very good at engineering, especially wireless engineering and communications. And I went to these interviews saying, I think I know about the industry. Now, I'm sure my pitch was bad. I'm sure my accounting was terrible because no engineer knows accounting. Learning in business school what accounting is. I never used Excel in my life till that point in time. But I went in pitching Apple long and BlackBerry short. And Jeff, not surprisingly, I got thrown out of every interview. Not surprising. And I asked them, do you know, guys, why you want to buy Apple? The pitch was Ram. Apple trades at 50, 60, 70 times earnings. BlackBerry is 6 times free cash flow, 7 times free cash flow. But I said, there is going to be no free cash flow. And they said, what do you mean? We love our BlackBerries. We're all going to be using BlackBerries when they have the new version. I said, what do you love your BlackBerry for? And they said, we love the keyboard. But I said, guys, the world is a capacitive touch resistor for your screen. You're not going to have a keyboard. And by the way, are your kids buying BlackBerry phones? Are they buying Apple? Oh, they're all buying Apple. So I said, why do you want to own BlackBerry? The other thing that they did not know that I knew was because Qualcomm builds the monopoly baseband chip on all phones around the world.
Yeah.
Again, by this time, I became a senior engineer and I was commercializing chips. We were not sending our teams to Canada. Everyone was going to Cupertino. And by the way, Apple had poached me from Qualcomm. I did not go to Apple in 2009. I went to business school instead. But in a different world, I would have just gone to Apple and worked there. But I did not go there. So the first insight I had, Jeff, was even when I was 29, 30 in these interview processes, my goodness, I think people, especially East Coast of America, they do not understand technology. And there is an arbitrage. So for me, the insight, remember in Chicago, you learn about arbitrages, economic theory, freedom.
Yep.
If there's an arbitrage, exploit the arbitrage. So I said, while I'm sitting here in these interviews and these people do not understand technology, so let me arbitrage that. Let me become a good technology analyst because I don't think people understand this. Jeff, funny enough, that was in 2010. This is 2025. 15 years later, Jeff, the arbitrage is as wide as ever and getting wider. It is crazy. And then Mark Andreessen coined that many years later. He called it the New York Palo Alto arbitrage. He called it that. These guys don't understand technology. And I still believe to this day, I think technology is so fast moving. It is so complicated. It is so nuanced. I actually believe that you have to be immersed in it to understand it in a way that can actually make money because technology investing is actually really hard. It seems easy in bubbles, but when the bubbles burst and things implode, man, there's a lot of destruction. So you're going to be very careful investing in technology. And so, anyway, the long story short is I saw the arbitrage. And so I said, okay, if that's the arbitrage, what do we know about finance? We exploit the arbitrage. So then I decided to basically become a good technology analyst versus trying to do different things. And then that was my first job in finance. In the summer of 2010, I was lucky enough to intern at Sanford Bernstein, which was a legendary research firm. And I was the top ranked analyst in that class. And they gave me a chance to pick my analyst to join full time. And so this is where another lucky thing happened. So now I graduated 2011, business school. Guess what was happening in 2011? The mobile internet, where I was struggling 5 years before to put a small connection through a system. Well, Steve Jobs had built the iPhone, the iPod first, then the iPod with the screen. And then remember the famous talk in 2007 where he said, and one last thing, here's the iPhone with a very thin data connection into the system. But what happened in 2007 and 8 is everyone started building on the App Store. And by 2011, when I graduated, the fastest growing internet company after many years happened to be Groupon. And Groupon was a Chicago company. And in my second year, the CEO of Groupon taught me a class called Building Internet Companies. So again, this is luck or is this timing? Is a skill? I don't know. I think I got a little lucky. But I saw that, I said, okay, wow, we've gone from simple phones to simple data on phones. The early version of data on phones actually failed because the only thing you could do is download a ringtone, play some games. It was useless. If you remember back in 2006 and 7, then the iPhone came, changed everything completely. And then we ended up in this world where we could get the App Store and then complete companies could be built on the back of the App Store. So I said when I joined Bernstein, because I had a choice to pick, I said, I want to build global internet. Because I thought the first version of internet was Yahoo and Google and stuff, and even Netflix had just made Netflix was just thinking of making the transition to streaming. And I remember the day when they announced the deal and it was down like crazy amount. But my point is, so lucky in 2011, I started researching Meta, Google, Amazon, Yahoo, eBay, and Netflix. So again, I was able to catch the first wave was just data on cell phones. The second wave was the entire App Store. And so we were able to capture that. And then I was very also lucky, my old boss. The other thing I've been very lucky about is I've had some very good mentors and very good teachers. So I think in life, nobody is born that smart. I think you have to put yourself in places where the greatest people in the world teach you what to do. And my personal belief is always find those great teachers. And so the quick TLDR for Octahedron is people say, do you want to be Co2? Do you want to be this? I said, no. From Philippe Lafont, I've learned this and this. From my old bosses, I've learned this, this, and this. What can I learn and what should I discard? And then that is Octahedron. Okay, that's a good segue into the firm. But anyway, my point is I worked at Bernstein. We became the #1 ranked team on Wall Street, me and my boss. Our big calls were we defended Google through the transition from desktop to mobile. Everyone thought Google was a shot in 2012 and 13. We wrote the black book on Amazon, on AWS on Wall Street. So I wrote the first Bible of AWS and cloud computing on Wall Street. And on the short side, because we had to pick longs and shorts, we were the only firm on Wall Street, I believe, to short Facebook at IPO because we thought they could not make the transition. The ad units did not really work. And that was just an incredible learning experience. And from that experience, I got my first buy-side job. Now, by this time, a lot of my clients were the hedge funds. My boss used to deal with the mutual funds. And by this time, I started learning about Julian Robertson and the rich pedigree and history of Tiger management. And many of these Tiger funds were my clients of mine. And you could see the difference in the questions they would ask you. Because I was a sell-side analyst, right? So a lot of buy-siders would call me. Man, I just felt like the training that these Tiger analysts had was just a step above almost everyone else. That is what my perception was. The depth of work, the intelligence, the data, the scuttlebutt was just a step apart. So I said, man, I want to go do that because that seems to be excellent. I networked a lot, and after a lot of good meetings, I was very lucky that another phenomenal fund manager called Rick Gerson, who had helped build Blue Ridge Capital with John Griffin, gave me a chance to go to a hedge fund. Again, it's very difficult, right? Most sell-side analysts. So again, in some ways, I got lucky. On the other side, I took chances, but it's hard for engineers to go to the sell side. Sell side to a Tiger fund is really hard because they typically only hire from private equity or banking. But he gave me a chance. And that was where I think the next inflection of my career happened, where in Falcon Edge, remember, Falcon Edge came from Blue Ridge Capital, and Blue Ridge Capital had a deep history of short selling. So I thought I would go there and be an analyst in public stocks on the long side, but Rick threw me a curveball. Rick and my old boss, guy called Navroz Udvadia, they threw me a curveball, and they said, you got to do shorts. And so with them, they trained me how to do shorts. And what is very interesting about that specific firm was both Rick and Navroz were very intense people, and they were very diligent. The Bernstein experience taught me modeling, communication, big thesis analysis. The Falcon Edge experience taught me intensity. How do you do scuttlebutt analysis? How do you build a network of people? How do you put a storyline together? How does that convert into numbers? And the beautiful concept of variant perception. So I learned variant perception because variant perception is what makes you make decisions on going long a stock or going short a stock. And so our entire framework at Octahedron is what is the variant perception? In fact, you saw me pitching stocks at our LP day, but what did I say? Everything was, I don't need to talk about the thesis. What's the variant? What do we know that the world does not know? Or what do we know that's not priced in yet? Variant perception analysis became the cornerstone of Octahedron's analysis, but that really came from being trained at Falcon Edge Capital. So Rick and Navroz really had a focus on, tell me about your variant perception on a stock. What do you know that the world does not know? If you don't know anything, it's likely priced in, but go do the extra work. So I really learned intensity, quality of diligence, deep modeling, understand all the puts and takes, and understanding what matters to a stock from them, both long and short. But even bigger, what happened to me was 6 months after I joined the firm, they said, you got to go to China. So that became what I call my love affair with China. So in October 13, for the first time, I was sent to China to diligence Alibaba's pre-IPO round and then D-Taxi before the merger between Kuaishou and Didi had happened. Sorry. Yeah. So this is before the merger, right? So what's really interesting is I went to China. I had never been to China in my life. I was amazed at how sophisticated the infrastructure was. Now, granted, I went to Beijing. It was October, crisp autumn evening, pleasant, beautiful, not polluted yet. And I was like, this is such an incredible country. Anyway, so I was very fond memories. We did our investments in Alibaba. It became a big pre-IPO investment for us. And then I went back and I told because I'm not a China analyst, right? I was just an Indian guy living in New York. But I went back and told both my bosses, if China is amazing things are happening in China. And this is version 2 of these companies. Tencent, Alibaba going public, JD, I think had already gone public at the time. Those big Chinese conglomerates were being built on the internet. I said, man, we should go to India and the same thing is likely going to happen in India. So I convinced my bosses to build an India fund, private fund, help them raise a little bit of money for that. And so by my second year, I was doing shorts mostly. The longs was so easy because you just buy Meta and Google and Amazon and go to sleep in some ways. And then I was doing privates, but not in China because I did not know the language. But I said, okay, we should build India. So talk about, again, I got lucky because my bosses, they allowed me to express the full breadth of my ambition and they gave me chances to fail. So I think for anybody listening on the call, the way I built Octahedron is if I was to fail and play for asymmetry, I do the same thing for my team. They should also get the chance to play for asymmetry. If they fail, I'll make sure that I take care of that. It's part of our cultural concept within Octahedron. Anyway, things were going well in New York. My wife, by this time, Annu, had gone from business school and she was going to be on a partner track at BCG's private equity practice. So she was doing private equity diligence work for the very large private equity funds, KKR, Apollo, Warburg, Pincus. But I just saw the way she was doing her diligence and I said, Anu, I think you're going to be really good on the buy side actually, versus giving consulting work. And also consulting in private equity is very complicated because it's constant churn of deals and it's very intense runs. So I said, maybe what you should do is actually take this insights and make money out of it for your companies, for the company you work for. Now, the challenge is that most private equity firms do not hire consultants. They only hire them for the operational practice, not for the investment practice, because they want bankers for that. So I said, but I think your insights are going to be great for venture capital. So then she went down the path of finding her way into venture capital. And because she is an incredible human and very intelligent, she was able to get her first opportunity with a very lucky break to work with Jeff Jordan and Mark Andreessen at Andreessen Horowitz, because they had built a firm a few years ago. They were looking to build out their research team. They saw the quality and intensity of research she brought in. So they hired her she became one of the principals. And she said, okay, I'm going to go and build extraordinary research and quality for Andreessen Horowitz. And that was so for her job, we said, okay, we're going to move to California. Again, it's a lesson on working with great people. See, listen, Jeff, it's so difficult to get a job in a tiger fund. I was doing well. Finally, we had some money. I took my first bonus and bought my apartment in New York. And now immediately we got to leave. It's a pretty stressful thing. This is where the asymmetry comes up again, right? What if it goes right? And if I fail, will my boss give me a job? This is where I think working with great people makes such a big difference. So I was very nervous. I went to my bosses, Rick and Navroz, and told them, guys, my wife is pregnant. She's got this great job in California. I'd like to go. I thought I was going to get fired. But guess what? They said, no, you're actually doing really well for us. Go and open our office in California. So again, it just goes back to working with excellent people and them giving you chances to do what you can. And so again, I was the beneficiary of asymmetry. So I moved to California, my wife's job 10 years ago. And I was traveling back and forth to New York. Of course, after a couple of years of doing that, it became too complicated. So then I got my third break, which is I started working. So my old boss and friend, Brad Gersner, who has built an incredible company in Altimeter Capital, he was looking for a senior analyst. And we got along very well. And he said, come and join me as my senior analyst. And by this time, I was traveling too much. I was probably getting too unhealthy, on planes a lot, and I needed to be with my family. So told Rick and Navroz that I got to leave, and they were very kind to me, obviously, and then joined Brad at Altimeter. At Altimeter, I started when the firm was, I think, less than 500 million. And that was my what I call my 1 to 10 scaling experience. Because Brad's opportunity was, see, by this time I had got good instinct, but most firms in New York are command and control. You report to a boss, you report to a PM. Brad was looking to basically get money makers. So he said, here's a corporate credit card. I don't care what you're doing around the world, just go make me money. What and I think I'm so grateful to Brad for giving me the freedom to fly. So I started covering global internet for him, global payments, and I had a 5 year just incredible run at Altimeter. We scaled the business from $500 million to almost $3 billion in the public markets when I left in 5 years. This is where China became a very important part of my life and my story because I made 40 plus trips to China in those 5 years. Because the only way for an Indian person in San Francisco to get any edge is to outwork the Chinese, and man, the Chinese work really hard. So forget 996. It was like
So you really work hard on that.
I was doing something crazier than 996, but I traveled all over China, Hangzhou, Beijing, Shanghai, Hong Kong, fell in love with the people, fell in love with the country, and really started respecting how Chinese entrepreneurs were building their companies. And also really got a ring seat experience on crazy Chinese competition. Crazy Chinese competition. But again, this is where China was so lucky. I made probably 3 or 4 big investments in China, but each one proved to be a blockbuster. So obviously, I was always long Alibaba. But the second one was in 2015. It made my career. I made an investment in ByteDance, so Jinri Toutiao back in the day.
Yeah.
And then to complete that triumvirate, I was a top 10 shareholder of Pinduoduo. So I was what a crazy story, right? And I think part of the reason we did really well in China was because because the average China analyst gets so focused on the details. I actually was able to take a step back and say, what happens if China works? What happens if these entrepreneurs are as great as they are? The market opportunity is incredible. What if they become global companies? Because till that time, there were no global companies from China in internet. What if they become a global company? And so so again, asymmetry opportunities and China was really my story into building the firm. And this is a few lessons I've learned along the way. And then we'll talk about Octahedron later.
That's a really amazing journey. You often mention luck. And sure, maybe luck played a part, but I think it's far from the whole story. There's clearly a lot more going on. Your ability to spot trends early, your discipline, and the way you've consistently positioned yourself to capture asymmetric advantages. That's not just luck. That's intentional. I feel like you've always had a sharp eye for identifying the big shifts, whether it's in your own career or in the markets. You've moved across industries, geographies, and roles, and each time you've managed to find the signal in the noise. That's rare. You've picked the right sectors, the right regions, and the right timing. And that pattern shows up both in your investments and in your personal journey. And maybe that's partly because of your background. You've lived and worked across multiple continents before you were even 30, and that global perspective really comes through. Plus, you started as an engineer, then moved into finance, so you bring both technical depth and market intuition. That's fascinating, and I'd love to dig deeper into that when we get into your investment philosophy, especially how you think about sizing, conviction, and going long or short. You've worked at some of the most respected firms and funds, and then in 2020, you made the leap to launch Octahedron. That's a big move. You were doing well professionally, financially, even personally. So what was the trigger? Was it about building something more founder aligned, more nimble? Was it about having the freedom to apply your own framework and make decisions with full clarity? I'd love to hear what really drove that decision. What made you say, now's the time to build my own thing?
That's such a good question, Jeff. So I think I'm going to start with a point of vulnerability. See, the reality is, when I was growing up, my dad worked in textiles. Now, textiles is a very difficult industry. It's very cyclical. And the reason we lived in many countries in the world is not because my dad was a big shot. It's because the industry was so cyclical and so vicious that the factories closed down. So I think from a very young age, there's a piece of research, and if you read the story of most great entrepreneurs, there's a famous line that says, the story of a son is written in the story of the father. The challenges your father goes through, typically father goes through, and the issues they have usually creates a long-lasting impression in some person's head. So for me, when I saw my dad being a very talented engineer, but always constantly cyclical because of the industry, I always felt like I don't want to subject my family to that cyclicality. I've got to be my own boss. So even when I was 19, 17, 18, I said, man, at some point I want to build a company. I want to be my own boss. And this, by the way, married when I went to Chicago, this concept of freedom. So I've always thought about freedom and independence is just part of my personality. So even though I did not know what to do, how to do, where to do it, I always had a belief that if I knew enough about something and enough, and if I believed in it hard enough, the universe will conspire to give it to me. So I always had that belief. So I always wanted to start a firm. In fact, when I joined Rick Gerson, part of the reason I wanted to leave him to join Brad was Brad had started the firm at Altimeter with very little capital. So I wanted to see what does it feel like, because in Falcon Edge, we had all the resources, like everything you want. It's a big tiger firm, big $3-4 billion launch, very easy to get resources and do it. But I said, what if I don't have those resources? How can I perform at a very high level without resources? And so for me, it was a practice in trying to be resource constrained and still being excellent. So that is the reason I left for Altimeter as well, because it's a smaller, younger firm. What happened though is, so one, I wanted my personal independence and freedom. Two, by that time, I had my own confidence that I'm pretty good at this idea of internet and payments investing. I'm pretty good at it. I've done publics and privates. I have a lot of confidence in my abilities to pick companies, both long and short. So now why wait? Because I turned 40 and I started my career so late in finance. So I'm a grandfather in many ways when it comes to finance. I started only when I was 31. See, most people had a 10-year head start on me. But as an immigrant to this country with no money, no resources, engineer, I had to accelerate. I had to at least try to keep catching up, right? And so I said, listen, I think I'm very good at this. I'm pretty confident the world is going to be constantly digitized. I'm pretty sure that I know how to make money under very resource constrained situations. And by the way, if I do it right now, by the way, also this goes back to having great bosses. And my old boss basically said that, listen, if you fail, just come back here. He gave me an offer to come back. So I said, goes back to asymmetry. What if it goes right? And because I'm pretty well known in the industry, I'm reasonably confident that if everything fails, great PMs will hire me to be a PM. Like I know this already. I get a job because I'm a moneymaker.
So it's a good option strategy. So you have a downside
It's a really a good option strategy. It's like literally an out of the call money option where you're paying a very low premium, right, to buy the option. So those are the few concepts, right? And so that was the reason. Now, there's a more philosophical reason to start the firm because there are so many hedge funds. Why would we also succeed? Now, by this time, the reality is I had looked around the industry. Remember, all this while for 15 years or 20 years, I've been reading business history. So I'm a student of business history. The story of Amazon, the story of Nike, the story of Costco, the story of Walmart, the story of McDonald's, right? These are great companies. And in fact, if you've come to our office in California, you'll just see it's all business history books, generally on our walls, right? And esoteric ones. In fact, the first book I ever read when I was 16 or 15 was Akio Morita and Sony. I fell in love with that book, which is a very interesting thing for a teenager to read in my teens, right? So I used to love that even then. Every business, Jeff, in my opinion, in my 20 years of learning this, can be decomposed into three simple things. You build something that people want. Number two, you hire incredible employees, make sure that they get a chance to do their life's work. And number three, you obsess about your customers.
That's right. So let me interrupt this a little bit. So that's very important point. So when you mention about these three important factors, they all need resources, right? So when you work for the big firm, and then naturally they can easily provide this kind of resources for you, and then you can hire the best talent. For the startup, how did you really overcome this hurdle?
Yeah, we had, I think, $12 million when we started. That was very small. So, Jeff, so the first thing is remember, every entrepreneur is irrational. Starting a firm is an irrational decision because the odds of failure are against you. There's a high chance that you're going to fail. So, every entrepreneur that I've met in my life has what I call irrational optimism that it'll work out. So, step one, I had irrational optimism. Second, the beauty in our business is that you need very little capital to start. The capitalization, I capitalized the firm with a couple of $100,000 to pay the base bills before I started the firm. So let me give you an example of how frugal we were. And number two is everything is IP, it's in your brain. And that's why the business is so profitable, where if you scale, your brain can be used for infinite returns on incremental capital. There's literally infinite returns on incremental capital. So the nice part about starting an investment firm is not that complicated if you realize that your input capital is your brain. Everything else is output. The mistake everyone makes is that they spend too much time and effort marketing. So they go out, they try to raise a lot of money, they have a very swanky office, they hire assistants and IR and operations team, and they just market without realizing the main thing is performance. So you got to invert the equation, number one. So what did we do when we started? So let's go back to the framework into we need a product people want. In my case, that was my brain, my historical performance, and my old bosses gave me my historical performance, so I had something to show. Number two, hiring employees. That is expensive. But remember, when I started the firm, I focused on my circle of competence, which is internet and payments, so I didn't need employees. I could, as we raised capital, we could hire people. And number three, obsession about your customers. That is my job. My job is to be obsessed about my LPs. And in fact, I've taken it one step further. I think of my companies as well as my customers. So I really take care of them. And that's why so many CEOs came and talked to our LP day. So my point really is those three frameworks, which is how product people want, obsess about your customers, and hire great employees, actually can be done in this business more than anything else if you're willing to invert what everyone else does. Everyone starts with they want lots of money, they want a nice office, they want travel budgets, they want to fly all over the world. I did nothing of that. What I started with is my capital, my old boss's capital, and then a few friends who said, I'm going to support you into business. Now, luckily for us, those few friends are the who's who in Silicon Valley.
Yes, I saw that. You must have something special to attract those people, those LPs in the Silicon Valley.
We'll talk about that too. But anyway, so you see my point. The point is those three things can be done with very little capital, but you have to be very good at your craft. So Jeff, many people come to me and say, Ram, I want to start a firm. Oh, but I need money for that. I said, no, you don't need money for that. What you need is an infinite confidence that you're a money maker. So are you a money maker? If you have that confidence, I believe you can start an investment firm because you put up performance, you scale slowly, it's your IP, and then that's how we build the firm. So today we run well north of $500 million, but it took us 5 years to get there. And I did it the difficult way, and I did it the way that is very sustainable and durable because I run the firm like I want to see my companies being run. Durability at scale for many years. And so I actually believe, Jeff, that's the reason I started the firm, because if you take that framework, I realized that most investment firms do not have it. So I was working in two firms that I think were very good from a culture perspective, and they paid us quite well, in my opinion. But if you talk to my peers who wanted to start a firm, they would tell you, oh, I'm leaving my firm because I didn't get paid enough. That is the wrong reason to start an investment firm. The reason to start an investment firm is you have an insight on the world and you want to make an excellent, legendary investment firm over time. That is why I started Octahedron, not to be a boss. Yes, I wanted the freedom, but I believed that two things. My competition was actually very weak. They did not focus on their customers. They did not have a great product, and they did not have great employees who loved them. Meanwhile, something even better was happening. As in your world, a lot of the incremental money in hedge funds has gone to the pods, right? Millennium, Citadel, SAC. Now, what is happening in those pods when I was interviewing lots of young people, they're very smart and intelligent, but they are not investors. They are traders.
Mm.
And the rise of these pods has created more volatility, at least in the US. So if you are a person with patient duration and with patient capital, you can exploit that arbitrage. But it gets even better. I can't even hire these analysts. So they're destroying an entire generation of young analysts because they're all trading, trading, trading all the time. It's very hard to make money in the long term by trading. It works for Ken Griffin. Does it really work for the PM or for the analyst? I don't think so. So it's so interesting. We are at this point of time where I actually believe that many single managers, they're struggling because they can't attract more capital because they've built the firm in the wrong way, in my humble opinion. Meanwhile, the entire industry, all the volumes are being sucked up by the big platforms, and understandably, because many of us have underperformed. But what if you build something that performs well? Then it's going to be very distinctive. So that is what Octahedron is. Very distinctive, high performance, focused on a few things, small team, and obsessed about customers, obsessed about my team's performance, and a product that hopefully everyone wants.
So will you stay that way in a relatively limbo size? What is your optimum AUM? If your style is to focus on the long term and discretionary high conviction, not a lot of trading, so that you can really achieve your long-term return.
Yeah, so Jeff, as there is only one, there's a rule of physics in finance, which is size becomes the enemy of returns.
Yeah.
So the first answer, Jeff, is I don't know the answer because I cannot tell you today. I cannot tell you today at what time my high performance will slow down. What I do know is in a previous firm, we could scale the business to 3 billion, and up to 3 billion, there was no performance degradation. So that's number one. So we are 500 million plus now. We're going to find the right partners, as we haven't raised external money in 3 years. We're opening this podcast because we want to attract a few partners who can be great partners for the long term. But ignore that for a second. So data point number one, till 3 billion, I didn't see any degradation at my previous firm. But data point number two. So typically, and I want to also correct you on one thing. I want to make sure I clarify something about the trading part. But the data point number two is every portfolio is a sum of underlying assets. Typically in our long short fund, we typically have 10 to 15 long ideas, round numbers. 8 to 15 is the right number, but let's say 10 to 12 in the median. And then we have long tail of shorts. The shorts are sized very small, so there is no, I can even short a mid cap and small cap, and it's not going to be a problem. On the long side, I look for a company that trades 2 to 400, at least 2 to 300 million dollars per day. Now, if I have a $200 million stock volume per day, and I want to get out of the stock in 3 days, I can put a $200 million position on the name. Now, if I have 15 stocks and the smallest position is a 5% position, then I can have 20 stocks of the same size. So 200 multiplied by 20 is a $4 billion stock fund. You see the math? So my fund can actually scale because, and by the way, my biggest company trades $4 billion per day. So there is no limits to it. It's not that the strategy will fail because we're buying the highest quality public and private assets in the world. And many of them tend to be scaled players. So if you look at our portfolio, we don't have any small caps, nothing less than $1 billion. In fact, a company today I was looking at, it's $1 billion in market cap, but it trades $7 million per day. We won't even touch it. Like, I can't do anything with it. So I'm looking for liquid stocks because, again, our LPs look at us for liquidity and exposure to the great tech trends of our life. So in many ways, Jeff, we're actually a replacement, in my opinion, for the venture capital portfolio. Because I'm going to make an argument to you that public stocks in tech are better uses of cash. And if you look at our historical IRR, the returns are like top decile VCs, but with liquidity. So I care a lot about liquidity, Jeff, because my wife also has a venture fund in our own family. She has an illiquid portfolio. We want a liquid portfolio.
Right.
So you see, even selfishly, I love liquidity. And what we've only done is I think we found a machine that generates high rates of return. I don't think there are limits to it, but the only way we will know is we go up that path and see if it's like walking up a hill. We do not know where we're going to get tired. It could
So,
be at the summit, in the middle,
right.
but we can walk up the hill. We have the equipment.
So in that case, because you mentioned about liquidity, you also mentioned about your kind of focus on the longer term investment return. How do you optimize this too? The liquidity, what I mean is really the fund level liquidity, not just the stock level
Yes.
liquidity. So because we also talk to the other similar lonely, the other is lonely fund manager, they really want their investor to be really long term, right? So almost hopefully no redemption kind of type, so that they can really align their investment goal with the fund's strategy. So how do you balance this two? How do you really optimize? You allow people to redeem in either quarterly or basis, and then at the same time, you also want to deliver a good IR for them.
It's a great question, Jeff. So step number one is I want to correct you on this long-term thinking. The reality is, from a practical perspective, the long term, we're all dead. First of all, I want to correct you on one thing. I think being long term is important, but the way I define long term, in my view, because tech is such a unique beast, it's so volatile.
Yep.
I would argue that after all my experience, I can only look out 3 years. I cannot look out beyond that. It's too hard because things change so quickly. The CEO will do something silly. Can you have imagined that in 2022, Mark Zuckerberg would spend all this money on the Meta Labs? No, there is no way of knowing it. Can you have written a DCF in 2005 that Microsoft will build Azure and then Azure will be the biggest driver of value creation of Microsoft? It is impossible to know these things. So first of all, when you say long term, I look at it as rolling 3 year cycles. To be clear, we are not venture capitalists. We are stone cold killers. We need to make money. Okay? Number one. To do that, you have to telescope between the long term and the short term. We never run 5 year models, 7 year models. In fact, I think it's a fool's errand to do it. We look for current quarter, current year, next year after. So today in 2025, we are rolling all our models to 2028, but really we are valuing our companies on 2027 because that's where we have highest confidence. Okay? So that's the first step. Now, then we come to risk management. This comes down to the liquidity question. If a stock is already reflecting its 3 or 2 years forward price, Jeff, we are taking risk off the table. We're selling the stock. So what does that do for you? In our long only fund, we've got rules on maximum exposure. And our LPs have agreed to allow us to keep up to 20% cash, which means that in times of extreme froth, or I'm a little worried, I don't see much asymmetry, I can keep cash. And our LPs are okay with it because our performance, even after keeping cash at times, is very high rates of return. So even though the cash is not a drag on performance, but the performance could be higher had we deployed it, of course. But I think the optionality to have cash is a very valuable one. And we agree to our LPs, that's what we do. The long short fund, it doesn't matter. The net and gross can move as it is. That's number one. So we take risk off when we think there is. In fact, I would argue that if you plot our performance during times of very high momentum, we underperform. So don't expect us to chase trends and chase the market. I get calls every day saying, Ram, get me into OpenAI, get me into Anthropic. We don't do it unless we put our personal money. I am not chasing a trend. I would rather buy Databricks when it's out of favor in 2020, which is what we did. That's our biggest position now. So similarly, I remember I was buying Google at 100 when everyone said Google is dead. I said, no, it's actually going to turn around. And guess what? Now Google's the most loved stock in the Max 7. My point here is the way you make the returns we do is you have to have a little bit of a contrarian bend. Now, also momentum has to work in your favor, obviously, right? Else you'll end up in a value trap. So there's an art to doing that. It's a real difficult art in doing that. However, my point to you on your liquidity is we keep a lot of cash. But the second thing we have done well, I think, is we are very discerning on the LPs we bring on. So as a chef, we have met at this point 4 or 5 times. And now we have the comfort level to have a deep conversation. But we do this with almost every LP. not just me. So I have a really good chief operating officer who you have met, Hab. He does the first 3 meetings. And then I do a couple of meetings too. Because, Jeff, unlike most firms, I am building a partnership
Mm.
and a community. We care about you, and therefore you should care about us. We will undoubtedly go through difficult times. There is no way you can be successful without getting through difficult times. But at a time, you have to have incredible LPs who will stick with you. Of course, there will be some redemptions. Of course, there will be. But as long as there's no run for the door, you're generally okay. So I think we've been lucky in the sense that while we have had redemptions even in our 5 years, it's generally been more positive than negative. And so I think the organization design, the way you bring on world-class LPs is almost as important as your gate. So let's talk about the gates.
I think that's also something I would like to ask you about. What sort of investors are your favorite? You mentioned about us. We met only a few times, but I feel that your investment philosophy is really aligned with mine. I hope that my clients are also aligned with that as well. We do see each other a good fit. That's why we really want to work together.
And that's why, Jeff, we're going to work together because we as Octahedron made a decision that you are a world-class person.
Thank you so much.